I'll show some slides and basically to bring you to numbers that should all be concerned about. All right. The world economy is sliding down fast towards the worst economic collapse since the Great Depression in 1930s. In our baseline scenario, the global economy will contract by 3.2% in 2020. Just to put it in perspective, this is twice as large as the contraction of the global output during the Great Recession in 2009. GDP of developing countries will shrink by 0.7%. In 2009, developing countries, despite a global recession, grew by 3%. In hindsight, it looks like the Great Recession barely touched developing countries. This will clearly not be the same this time. The worst case scenario could be far worse. We could see a 4.9% contraction in global output in 2020. Cumulatively, the world will lose $8.5 trillion of output in 2020 and 2021. That is enough to wipe out all the GDP that were added during the past 4 years. Colleagues, nearly 90% of the world economy came under some form of lockdown during the past 2 months. The lockdown measures have tamed the spread of the virus, but with very high economic cost. Policymakers are increasingly facing difficult trade-offs between saving lives and saving economies. Unfortunately, there is no blueprint for an economic response to the pandemic. Transportation, travel, hospitality, and retail sector jobs that account for nearly 1/3 of all jobs worldwide are the hardest hit. Within these sectors, small and medium-sized enterprises are facing the brunt of the impact. Most developing countries rely on more than one source of external flows, namely exports, tourism remittances, and sometimes ODA to balance their current accounts. Developing countries that are heavily dependent on commodities, tourism, or remittances will experience sharp decline in their foreign exchange earnings this year. Many of them will face significant deterioration in their balance of payments. Most heavily indebted countries among them will find it difficult to service their debt this year and possibly face catastrophic debt crisis. Large fiscal measures rolled out by developed countries, as large as 10% of their GDP, have not prevented the sharp contraction in economic activities. Developing countries has been less fortunate in implementing necessarily large fiscal measures, as many of them are settled with high levels of debt, public debt, and have very limited fiscal space. Stimulus measures are unlikely to boost consumption and investment in the near term, so long high levels of uncertainties persist in the global economy, especially uncertainties regarding the spread of the virus. The stimulus measures in large developed economies have had some unintended consequences on developing countries. We are seeing massive capital outflows from developing countries, which is basically a flight to safety. We are seeing exchange rates are depreciating very fast for some major economies, emerging economies, and borrowing costs are rising for many of them, making it harder for these developing countries to finance their stimulus measures. Even without these unintended consequences, stimulus measures are unlikely to boost investments. If businesses believe that demand will not pick up anytime soon, they will not invest in expanding productive capacities. We may witness a downward spiral in the global economy with low investment and low growth and low demand. Governments may require, as a solution, businesses to invest in productive capacities as preconditions for receiving cash and tax reliefs and other kind of support measures as part of the pandemic response. The crisis response is clearly and disproportionately hurting jobs that involve physical interaction with customers and fellow workers. These are low-skilled, low-wage frontline jobs that cannot be done remotely. Massive job and income losses will invariably increase income and wealth inequality, both within and across countries. In our worst-case scenario, the number of people living in extreme poverty, that is earning less than $1.90 a day could increase by 160 million people between now and 2030. And that is relative to our baseline forecast that we made in January 2020, and it could be worse. Rising poverty and inequality will further weaken social cohesion, tolerance, and breed discontent, instability, and even conflict. The world will face a new normal after the COVID-19 crisis. Unless there are convincing breakthroughs in vaccine and treatment of the disease, we'll face a new normal of prolonged economic slump. Low growth, low global trade flows, low investment, and low economic activities. Consumption and production patterns may fundamentally change as the process of automation and digitalization will accelerate, because many businesses would want to reduce their risk by cutting their labor demand. This will likely reduce labor demand, leading to a higher level of unemployment relative to pre-crisis level. Stronger international cooperation will remain an imperative to minimize the economic fallouts of the pandemic. The international community has already responded with much needed moratorium on debt servicing and some form of debt relief for a number of countries, developing countries. But more international support, especially more credit and liquidity from multilateral sources, will be needed to recover better. The current crisis offers an opportunity to build resilience against economic shocks and future pandemics, to strengthen social protection, to reduce inequality, and address growing climate risks. In this regard, the UN can play a very catalytic role in ensuring that countries can recover better from the current crisis. Thank you.
Thank you very much, Mr. Rashid and Mr. Harris. I'm Martina Dolman from UN Global Communications. I'm just taking over the moderator role. So we do have a few questions that have come in. The first one is from Majid from Rudo. Please turn on your microphone and your video when you're asking the question.
Yes, thank you very much. Thanks for this briefing. My question is about the oil-rich countries. As you know, the price of oil has dropped and is dropping. I want to know what do you think? What does the United Nations anticipate in terms of the impact of those economy and in terms of price of oil? Is it keep going down until the end of this crisis, until the 2021, and with focus on the Middle East region? Thank you very much.
I'll start off with a brief response, and Hamid, you can come in with the later details. Oil, like other commodities, has experienced a very sharp decline in price, driven by the declining demand for energy. And that is, of course, linked to the economic lockdowns that have been happening around the world. We also have a situation where the supply of oil continues to have been produced, and the stockpiles of oil have reached capacity. So the market is awash in oil, demand is low, and there has been difficulty as well among major producers in coming to an agreement on pricing policies. Now, the way we see it is that, of course, countries that are very heavily dependent on particular commodity exports are very vulnerable to this slowdown in demand and to the weakening global prices for these commodities, and that is particularly valid for the oil companies, for the oil countries, sorry. But what we also see as a problem is that even after the economic activity begins to recover slowly, because we have such large piles of stockpiles accumulated over the past few months because demand has been weak, it will be some time yet before oil prices would catch up, if you will, because there is just a very large supply of oil available. Now, of course, this does pose an issue for these countries who are very dependent on oil revenues as a central part of the tax revenue of the government budget, because that does constrain the ability of the countries to maintain their public health systems in the face of the threat from the virus, but also to execute fiscal stimulus packages to prop up their economies. And this is a question that is going to continue to preoccupy the governments of these countries in the months and perhaps even all of next year as the oil markets gradually start to recover, but may not recover as quickly as we would otherwise expect. Hamid, I'm not sure if you want to add something onto that.
Just to add one additional point, that in addition to what we have in terms of demand and supply, but there might be a permanent shift in terms of the behavior. We may have less travel going forward, less demand for transportation, and that would probably lead to a more longer-term depressed demand for oil. So it might be a longer-term shock, and we don't forecast oil prices. Actually, nobody tries to even do that because it's very difficult to forecast oil price. But the signs are there that even after the crisis is over, for the foreseeable future, oil price will remain depressed because there might be a much longer-term structural shifts in the global economy that would depress demand for oil. Thank you.
Next, we have Abdelhamid from Al-Quds.
Thank you very much. My name is Abdelhamid Sayam from Al-Quds Al-Arabi. In fact, my colleague Majid has just taken my question, but I will ask another question about Palestine. Do you see that the Palestinian Authority may collapse because of economic hardship, as we see Israel is holding the revenues that it collects on behalf of the Palestinians, and the US aid had been stopped, and of course, because of Corona, COVID-19. So do you see the situation is coming to a catastrophe in the West Bank and Gaza? Thank you.
Well, I'm not in a position to make a comment about the particular situation of the Palestinian Authority. This authority, like every other government, faces additional strain from the COVID crisis, clearly with economic activity as deeply constrained and restricted as it is, clearly with the change in some of the social outcomes for the worse. It presents an additional challenge to any and every government and administration. And of course, with resources severely restricted, the ability to react is compromised. This is a situation that all governments face, but I'm not willing to be able to say, or not able to say, anything about the prospects of the Palestinian Authority over the longer term. That's as much as I'm able to say at this time. Thank you.
Next up is Toby from NHK.
Hi there. Thanks very much for your report and for taking my question. Toby Burns from NHK. I have two questions. One is, which countries have been doing stimulus well, and which countries have been doing stimulus not well? What lessons can we learn? I think a couple of weeks ago, the Secretary General called out the Republic of Korea in a positive way for their specific response, both medically and in terms of policies and recovering better. So I hope you could comment on exemplars for us. And then the second question is on supply chains. Because global supply chains have been so affected by the pandemic, do you think we should see a greater reliance from national economies on to be self-reliant? Should we be seeing significant logistical restructuring in order to prepare for this sort of thing in the future? Thanks very much.
Thank you, Toby. On the question of the stimulus packages, one of the distinguishing characteristics is that each stimulus package is relatively specific. It's very hard to compare what is done in one country with what is done in another country because they've been responding to the particular situations that they face. So you will have, for example, countries where there is robust social protection, systematic social protection in place. Their stimulus packages will not necessarily contain measures to protect against social decline. They will already have unemployment arrangements in place. They will already have health insurance in place. And so their packages will not necessarily have to include additional measures in that respect. Whether or not that makes a difference depends as well on how the economy has been affected. Now, we have in some economic structures a very large share of workers who are in low income, low wage activities where close proximity with others is required. These workers have been particularly hard hit by the economic restrictions. And so for those workers, there is a need for a much more aggressive support package aimed at them. So whether or not the packages are comparable depends on the economic structures within which they take place. And it's very difficult to say that any one or other stimulus package is better or worse than any other one. It's a question of how well it responds to the economic circumstances of the country. Now, on the other hand, we do have differences in the types of public health measures that have been put in place. And those measures then determine how quickly or how expansively the economies will be able to be reopened as we sound we withdraw some of the economic restrictions that have been put in place, the containment measures. And the Secretary General had spoken about South Korea explicitly in the context of both its public health response and the way in which it had formulated its support measures, bearing in mind that, of course, those measures were specific to the South Korean circumstance and could not really be compared one-to-one with measures put in place elsewhere. On the supply chains, I do think that there will be a lot of consideration given to whether or not the long supply chains that we've become accustomed to over the last 20 years are necessary, and given the vulnerability that they so obviously demonstrate, whether they are something that we want to save into the post-crisis world. I'm not sure that it is in the interest of any country to try to push deep self-reliance. I mean, the benefits of trade are very, very large and are very clear and have been for quite some time. But I can imagine that some of the just-in-time type delivery models that we've come to depend on might be reconsidered. And some of the supply chains may be a little bit less long and involve less stations in different parts of the world than they have done over the past years. Not necessarily that this is going to make things any more efficient, but it may very well be one way in which the countries try to reduce the potential vulnerability to shocks in the future. Hamid?
Yes. Thank you, Elliot. I think just to add, in terms of the stimulus measures, I think the biggest challenge for policymakers is not rolling out the large stimulus, but how does it translate to boosting consumption? Because in many cases, the stimulus are protecting income and jobs and probably preventing bankruptcies as well for small and large firms. But given the restrictions on economic activities, often people receiving cash transfer from the government, they are unable to spend. So they are not able to contribute to boosting demand, which is keeping the economy depressed. So it's a catch-22 to some extent, where the stimulus, even with the best intention, is unable to stimulate economic activities. So all of this would then boil down to the uncertainties that I mentioned, that if we can eliminate or reduce uncertainties about the future course of the virus, then even a small stimulus may have huge impact. On the other hand, if the uncertainties persist for a prolonged period of time, then even a large stimulus may not achieve the intended results. So I think this is a situation that we are facing right now. In terms of the challenges with supply chains, I think what Elliot mentioned, I think just to add that there'll be a sort of temptation to mitigate risks, because when we have supplies coming from 10 different sources, there are risks if one of them falter, one of them breaks down, then the whole production process can suffer. So there'll be some kind of alternative measures, and there can be some kind of reshoring of some activities, which might further slow down or drag down global trade. And I think that's just something that we have to be sort of aware of, and that's a risk to global economic growth going forward, because we have ample evidence that trade is good for growth. But in the post-COVID world, we might see less trade because of risk aversion that many countries would have, because they won't have any disruption in their supply chains. Thank you.
Next, we have Edith from the AP.
Thank you very much. And on behalf of the United Nations Correspondents Association, thank you both for doing this briefing. My question has to deal with the report saying that 34.3 million people can be plunged below the extreme poverty line this year, 56% of them in Africa and possibly 130 million more by 2030. Could you tell us what some of the other moving factors are in this, and what is the extreme poverty line at this point? I know at one point it was $1.90 in US currency. Thank you.
Hamid, I'll leave that to you.
Yeah, thank you. The poverty line is right now, the international poverty line is $1.90 still per day. And this is the line that we used to make our forecast. And you're absolutely right, the numbers that we have, this is for our baseline scenario. About 34.3 million people will fall below the poverty line. And, if we can assume that who would be those people, because these are the people who are just above the poverty line. They are low-skilled, low-wage workers, mostly in many developing countries, are in the manufacturing sector or in the service sector jobs, and there are those sectors are being hardly hit. There will be also tourism sectors in many countries, especially in small island developing countries, where many of these low-skilled jobs are in the tourism sector. They'll also fall below the poverty line, because the working poverty, even if there is some recovery, the working poverty rate would increase. And this is our, the 34.3 million people that we are looking at is our baseline estimates. It could be worse if the global contraction is deeper. And if we see the worst case scenario materializing, we could have significantly more people living in poverty or plunging into poverty. Thank you.
And if 56% are in Africa, where are most of the rest? In Asia, some in Latin America, where else?
In South Asia, of course, in Bangladesh, India, and other countries where there are deep pockets of poverty, and also some in Latin America, but predominantly in Africa.
Thank you.
Thank you.
Next, we have Arul from IINS, please.
I have two questions for you. Can you hear me?
Yes.
Yes.
Okay. I have two questions for you. One is, what is your reaction to the stimulus package that was unveiled by India, which was done yesterday? It's about 10% of the GDP, and it's about $250 billion. And the second question is, there's a difference between the IMF's growth projection for this year, which was 1.9% for India, and yours, which is far less. Could you please explain why you have a lower estimate, or why the IMF has a different one? And thank you.
Let me take this second question first. We and IMF, we use slightly different sort of exchange rates for measuring or forecasting our growth. IMF uses PPP terms, purchasing power parity terms, which gives more weight to developing countries, and that shows slightly higher growth rate than we would have. And we use the market exchange rate. So I think that partly explains the difference in forecast. But on average, our forecast and IMF forecast have been pretty much in line with each other and consistent. So I don't want to give a specific number about India, but most of the difference would be explained by the choice of exchange rate that we have in the forecast. In terms of the stimulus package that was announced yesterday, this is a very welcome development in terms of 10% of GDP, largest so far in developing countries, because most developing countries have been announcing or rolling out stimulus packages that are between less than 1%, between 0.5 percentage point of GDP to 1% of GDP. And India's stimulus package is very large, and also India has the domestic financial market and the large sort of capacity to implement that large stimulus package. But what is probably would look forward to is the details of the stimulus package that has not been announced yet, and that would actually the impact would depend on the design of the stimulus. So at this point, we can't say anything more than that because the details have not been made public as yet. Thank you.
Next, we have Kaori from Nikkei.
Hello, can you hear me?
Yes, we can't see you.
Okay. I have two questions. We're already seeing reports of the virus reemerging in parts of Asia, and you've offered a pessimistic scenario in which a second wave would occur. Which regions and sectors do you expect to be hit hardest, and what are your projections based on? And my second question is the managing director of the IMF mentioned yesterday that the fund is going to revise its global output forecast downward from the 3% contraction it announced back in April. Given that your baseline is kind of roughly in the same ballpark, do you think that it's more likely that your pessimistic scenario of a 4.9% contraction play out even without a second wave? Thanks.
There you go. Yeah. I think we are sort of aiming a moving target. Right now, it's given the fast-moving scenarios globally, it's very difficult to have a point estimate, and that's why we had a worst-case scenario. Even the worst-case scenario may not be sufficient to capture the full impact of the crisis. Our baseline assumption was that containment measures would not go beyond the second quarter. All the impacts would be minimized and during the second quarter, and the third and fourth quarter would see a robust recovery, and that will make up for all the lost output in the first two quarters. But there are clear signs right now that it would spill over to third quarter with the relapse of the virus in some countries in East Asia and others. That means containment measures would continue into third quarter of the year. Which would mean that we would probably revise our forecast also downward. But as of now, we would like to believe that our pessimistic scenario is probably the bottom line as of now. But again, if you ask me 1 month down the road, and if we have the same trend continuing, we may have to revise it further downward. Thank you.
And the last question goes to Mario from EFE.
Hi, thank you. Could you elaborate on how you see the recovery playing out? You're forecasting a pretty quick rebound, but you also, in this worst possible scenario, you speak of the possibility of the contraction still going into 2021. Do you expect the consumption to come back quickly after the lockdown measures are lifted, or do you think that the fear of the virus is going to keep that low for a long time?
Let me offer a brief comment sort of to frame that. One of the issues that we've tried to encourage government authorities to keep in mind is in their stimulus packages to try their utmost to preserve enterprises, to prevent bankruptcies, and to preserve jobs. The simple fact is that many of the smaller enterprises or smaller medium-term enterprises will have great difficulty in surviving a longer period of shutdown. And if these small enterprises are in receivership or going bankrupt, then of course they are not there physically to respond and recover when the restrictions are lifted. And so that, I think, is going to be one of the major concerns that we will face in terms of the recovery of consumption. Just to give a concrete example, if it should be that in the reopening of the economies, social distancing measures are preserved, and the government authorities insist that there be a certain minimum distance among diners in a restaurant, then physically the restaurant will be able to serve many fewer people, and the waiters in that restaurant will earn a correspondingly lower wage. That means that will translate directly into lower consumption. Now, we can't see in exact terms exactly how quickly that will play out, but we can expect that there will be a certain hesitancy in the recovery until people start to feel more confident and the uncertainty about the impact of the virus is brought down to a more manageable level. And so we can see it picking up, but it won't be returning to the pre-crisis levels overnight. And that, I think, is one of the concerns that many of the countries are going to be facing as we move into the reopening. In addition, it may not be a simultaneously reopening across all sectors of the economy. So we will see, for example, that the tourism sector is going to recover with a lag, because it will await the time when people feel comfortable enough to go on holiday again, and when people have enough disposable income to do so. Hamid?
Yeah, thank you. I think this is again a quandary for economists and policymakers, exactly what will be the shape of the recovery. We can anticipate that recovery next year, even if there's a recovery, would at most be a technical recovery, meaning that this will basically make up the lost output this year. Even that probably would not be fully recovered next year. So in terms of the strong rebound, there are quite a few constraints. First of all, many of the spending would be discretionary spending for households. Even if there's an economic recovery, there will be an hesitation or risk aversion on the part of the households to save more. So that we might see that households would want to postpone some of the consumption that they would have done otherwise, even in a good case scenario. And then even if there are some pent-up consumption demand, some demand for durable goods may go up very quickly, but some demand for which is less pressing, they may suppress or postpone it for the time being, and that would hold back the recovery going forward. So what we would see is that a rather slow recovery, even in a good case scenario. But one last point that I want to add is that about that if we even have some kind of social distancing in place as a new normal, the big challenge for businesses would be whether they can operate under the full capacity, meaning that if restaurants are asked to operate with 30% occupancy, that may not be the break-even point for many businesses. They would, regardless of economic recovery, they would go under. So, and this would be also true for retail businesses. This will be true for hotels. Hotels, if they say we can only have 30% occupancy at a given point in time, they have seasonal variations in those businesses. But if the seasonal variation becomes a permanent variation, meaning that you cannot ever have occupancy exceeding 30%, then many hotels would not survive. So because they have very high overhead costs. So that brings back to the point of we might see a permanent rise in unemployment levels globally. And that is a risk that we cannot discount at this stage. Of course, if we have a major breakthrough in vaccine and treatment and all the fears are gone very quickly, then we may come back to normal. But for the time being, we don't see that in the horizon. Thank you.
Thank you so much to the speakers and to all of you for your interest. I think this concludes our briefing. The slides will be available on the website for the report, and the speakers are also available for interviews. So please contact us if you want any more information. And thanks again.
Thank you.
Thank you very much. Thank you.
Thank you very much.